Okay. So far, what we have learned uh, up to previous session, that is we focus mostly on the irrationality of the investors. So we didn't think that other participants in the financial market, such as the managers, corporate managers, can also become irrational because they are also human beings. So the idea is that as managers are also human beings, they may act irrationally sometimes. So there are two hypotheses. One is rational manager and irrational investors. And another hypothesis is irrational managers and rational investors. So you might immediately recognize that when one person is rational, I mean one party is rational, another party is irrational, it is easy for the rational party to exploit the irrational person or irrational party. So say right now we are discussing the rational managers and irrational investors. So you can immediately recognize that if it is somehow turned out that rational managers have recognized that investors are acting irrationally. So in that case, it will be very easier for the rational managers, or it will be kind of a cup of tea for the rational managers to exploit the behavior of irrational managers. So we'll try to see how rational managers can exploit the irrational behavior of the investors. So we need to recognize two things. That one thing is managers can also be irrational, like the irrational investors, as long as managers are human beings and they also are part of financial market, and anything which happens in the financial market actually comes from the interaction between the managers and the investors. So either party can be irrational. So that is the first recognition. Second recognition is that managers sometimes take the opportunity to exploit the behavior of irrational investors. In today's session, what we'll try to see, what are the ways how managers can exploit the irrational investors and make money out of it. So I hope you have got the purpose of today's session. So before diving into the main discussion, let me ask you what you have learned so far from your finance class regarding the goals of the managers. What you have learned, what is the goal of the manager, or what should be the goal of manager?
Sir, the goal of the manager should be to increase the share price of the company.
Okay. Thank you. That is very precise. To increase the share price of the company. And neoclassical finance, on which we are heavily dependent, they assume that manager increase the share price by enhancing the present value of all future cash flows of the firm, and managers look for the ways how can we increase the present value of the future cash flows, and that should be the number one objective, or that should be the number one in the value function of the manager. What manager for what purposes managers are appointed in a firm. But in addition to this goal, which is mainly from the neoclassical finance, behavioral finance has discovered that other than this goal, I mean the maximizing the value of the share price by maximizing the present value of future cash flows, managers, it has been observed that managers also engage in two more goals which are conflicting with each other. So one goal can be they go for increasing the when you have mentioned the share price, it should be more precise if we would mention the share value or shareholders value, because you know the difference between the value and the price. So price may be in the control of the investors, price may not be in the control of the managers, but which will be in the control of the managers, or on which thing managers can solely focus on maximizing the value. So if the value of the share can be increased, it is expected that price will also increase. But it is also possible to increase the price of the share without increasing the value. So that is kind of conflicting, what I just have mentioned. Increase the share price without increasing the value. So, but sometimes it has been found that in addition to the goal, which is to maximize the present value of the future cash flows, managers engage in maximizing the current share price. So maximizing the current share price is obviously good if it is done by maximizing the present value of future cash flows. But sometimes it has been found that managers take some actions to increase the price of the share in the market by targeting something, or by targeting some activity, or by targeting some attractive things which attract or which influence the valuation perception by the investors. So that thing, for example, investors nowadays, for example, investors nowadays like X. I'm not mentioning what is X. I will mention X later. So if managers have recognized that investors are nowadays preferring X, managers might engage in giving more X to the investors, because they have found that if it is done, can I take a break for a couple of minutes because I have a phone?
Sure, sir.
Sure, sir.
Let's resume our session. Sorry for the interruption. We are in recording. Yeah. So what I was mentioning, that if investors are nowadays preferring X and managers have recognized that investors are preferring X, what managers can do, managers can increase the share price of their firm by giving more X to the investors. So that is a strategy to increase the share price, but that is also known as catering. That is known as catering, okay, or catering the current need of the investors or current expectation of the investors. So if managers engage in this kind of activities, you would see that this kind of activities, because investors are preferring this, that's why I'm giving this, and that's why investors are now happy, and investors are now paying more price for my share. So it is not a kind of value enhancing activity, which is strongly mentioned in the first objective. Okay, so it is also possible to increase the current share price by catering investors. So there are different ways. We'll give some examples later. So this is number 2 in the value function of the managers, what managers might do in addition to the maximizing the present value of future cash flows. Have you got the basic idea of the second part of the value function of the managers? Have you got the second part? First part is very well known to you, but have you got the second part, that how it is possible to increase the current share price by catering the investors? Have you got the idea? I will give you the example later. Yes, no?
Outcomes that investors might prefer rather than to what is best for the company.
Sorry, how?
Outcomes that the investor might prefer, but not the best for the, what might not be the best for the company. Like
Right.
Ruby declaring a dividend where they raised the capital just last year.
Exactly. What Robi did, that is an example of catering. Okay, that is an example which we might include in the point 2. Okay, or second part of the value function. Dividend is one of the very common ways to cater the investors expectation. Okay. Okay, so I feel that you have got the idea. And number 3, we'll see some examples of catering later, but let me give you the brief idea of number 3. That is the timing the market. So you know that investors time the market by knowing when it is the right time to enter or when it is the right time to exit the market. At the same time, managers have also timing, and they want to exploit this by appropriate timing. So one very common example of market timing by managers is that when their share price is overheated, their shares are traded at a very high price. Managers strongly believe that it is the right time to issue more share and sell it at a higher price. What will happen if they sell their share at a higher price? It will hurt the new shareholders who have been persuaded to purchase the share at that high price, and that is the reward to the current shareholders. So what they do when their share price is overheated, they do repurchase or they do buyback or they issue more shares. So you will see that they engage in IPO or they engage in RPO, they engage in seasoned offering. Okay, sorry, this is RPO, repeat public offering. Seasoned equity offering, you will see they do this kind of activities, or they issue more shares when they believe that their shares are now traded at a higher price. So what are they doing? They are timing the market. Okay. The opposite thing, when they see that their shares are traded at a low price relative to the value, they engage in buyback or repurchase. So buyback their shares from the market at a low price relative to the value. Again, it gives good return to the shareholders who are currently holding, and it comes at the expense of the shareholders who sell their positions. So this is also part of the value function that is in short known as the timing the market, and that is done by the managers. So in addition to the increasing the present value of future cash flows, managers might engage in two other activities which come from the behavioral explanations. So you might know it very well that for what purposes or for what reasons investors increase the price of share price of one firm, or the investors depress the price of share price of another firm, because you have learned that in the financial market, though arbitrage is expected, but there are a number of constants to the arbitrage. So because of the full presence of the arbitrageurs in the market, irrational investors dominate, and irrational investors take the share price sometimes above the value of intrinsic value, sometimes below the intrinsic value. So for that reason, which are actually caused by the irrational investors, managers exploit that pricing by issuing or by repurchasing their share, and by timing the market appropriately, managers generate value for their shareholders, generate value in by doing these kind of activities, but these are not related to the increasing the future cash flows to the firm. Okay, so before going to detailed discussion, let me share some examples of catering, which are part of, which are in the part of the second point, which we mentioned, that when managers recognize that investors are preferring some certain things, so managers act in a way to disperse or to distribute those things to take the share price to at a higher level. So that kind of a strategy is known as catering. So one example of catering is the changing of name of the company, changing name. So one common example, I will give example from our country later, but one common example from the history is that you probably have learned about the dot-com bubble, which happened in the late 90s. So what happened in that time, investors in that time are got very much optimistic about the prospect of the internet companies, and the companies in which they have found the company's name are in this form, for example, x.com, and at the same time there is another company Y. Investors thought that x.com will be more valuable relative to Y, because .com is there with the X company name, .com is not there with the company Y. So you might feel that in 2021, it was total bullshit. But during 1990, I mean the late 90s, investors acted in this way. They just have looked at the company name, and they believe that if the company name contains .com, they believe that it is more valuable related to another company in which there is no .com. And sometimes it has been found that this .com has no linkage, no relationship with the company business. Say, for example, what should I say? Say, for example, a company which is engaged in the cleaning of dust or cleaning of substance from the drains in the public areas. So what you will recognize that company will not have much value if that company is present in the online and that company has an address like this, because their business is their business operation or their business idea is far from the .com or the internet companies or the e-commerce companies, these things. But actually it happened. Whatever the business of the company, if that company adds .com with their name, they are traded at a higher price in late 90s. And this is one example, changing the name. So example for what? Example for catering. Catering by whom? Catering by managers to the investors. Okay. Another example is that if it has been found that you probably have learned from your dividend policy or from your financial management that dividend policy varies from company to company. Sometimes some company are recognized for high payout. Some companies are not preferred by investors for low or no payout. So it has been found that based on the preference of the company, based on the preference of the investors, preference for what? Preference for dividend, company managers had their dividend policy. So that is kind of behavioral explanation of changes in dividend policy. Investors look at the investor's preference and decides that how much dividend I should pay, or whether I should pay dividend right now or I should not pay. So you probably have learned from your neoclassical finance that a larger company, matured company, which have large amount of cash balance, which do not have sufficient or new profitable investment opportunities, they are more likely to be the companies who will be paying high dividend or hefty amount of dividend. Like you can compare this kind of company in our country, you can compare, or you can take example of Bata Shoe. Then you can take example of Marico, who are very recognized among the investors community for paying high dividend. So one of the good reasons why they pay high dividend is because of the characteristics I just have mentioned of the dividend paying company. And another extreme is that when the farm is very small, farm is very new, farm is in a very growth stage, they require the investment money, they require investment need. So it is not very feasible idea for these firms to give out give out their cash balances to the investors in the form of dividend, it is better, and also their cost of fund is lower if they use the fund internally for their investment by avoiding the payout. So these are some characteristics of dividend paying company and non-dividend paying company. These are some characteristics. But it has been found that, okay, I will explain it more detail in later. It has been found that gradually dividend payout by the companies are on an average in the declining trend, regardless of these characteristics. So several studies had been made for finding out the reason. Without changes in this kind of characteristics of the company, what is the reason why on an average that payout is declining over the time? So this is an example of catering. More precisely, managers wanted to look at the investors' preference. What kind of preference investors are making? Investors are preferring dividend paying company, or investors are preferring non-dividend paying company. Based on that preference, managers cater this kind of investors' need and decided whether I will pay or whether we will pay dividend or not. And other kind of catering examples are changes in accounting policy, or managing some earnings, and changes their industry category. This kind of, you will see several examples later. Okay, so you have got the conflicting three goals of managers, and we will try to see these points more detail now. One, the number three, in which case we mentioned that managers capitalize on the timing. So it has been found that when shares are in the high trend, I mean they are trading at a higher price, managers engaged in high issuance activities. So high issuance activity might be recognized by irrational investors that I can participate in this new issuance, and that is good for me. But only managers know that it is the time at which my shares are traded at a higher price. So it has been found that high issuance in the market causes low future return in the 12 out of 13 major market. And also they generate a return which is below the market average return. And another activity which is done by the manager, which is part of the catering, and also it can be explained by how managers exploit the irrational behavior of the investors. Remember, our focus is on how managers exploit the irrational behavior of the investors. So we will focus on particularly three examples of catering. One example, remember the timing of the market is not an example of the catering. I mean the share repurchase or share buyback are not the examples of catering. They are examples of market timing. So in merger and acquisition case, you are, I believe that you are familiar with the merger and acquisition activity, which is a very common trend which occurs on a day-to-day basis in developed country. But in our country, we see it very rarely, and there are so many complexities which reduce the merger and acquisition activity in our country. And you know the very basic reason for merger and acquisition. Very basic reason is the presence of the synergy. And if it has been found that 2 plus 2 are not equal to 4, rather 2 plus 2 equal to 5, In that case, managers believe that there are synergies, and they try to make it also believable in the eyes of investors that we are going to make a transaction which will give us 2 + 2 = 5 because of the presence of synergy. So be happy for that. And in this way, managers also pursue the investors to keep with their firms. And that is how merger and acquisition proceed. But in reality, it is theoretically, it is very plausible to talk about the synergy, that how synergy might arise. But in general, nowadays, merger and acquisition, these activities are in general not preferred by the investors, So I'll try to explain what are the reasons for why they do not prefer the merger of two firms. So one fundamental reason is that obviously synergy might happen or synergy might not happen. So we need to make sure that the synergy, what will be the present in the merger between two firms must be greater than the cost of the merger. I mean, I will pay a particular cost for making this merger happen, but it should not be like that the cost exceeds the synergy. And I will pay premium for the synergy, and you need to make sure that the premium for the synergy is not overpaid. So these are some equational explanation, but another fundamental explanation regarding the synergy is that synergy is very theoretically very sound to hear or very plausible to hear, but objectively it is very, very difficult to measure. We might believe, or managers from both firms might believe, that we will be engaging in cost reduction, or we will be engaging in revenue enhancement. We will be sharing our thoughts, or we will be sharing our technologies. This will reduce our cost. This will reduce our cost. This will give us more revenue. These things they might think, but it has been found that as it is very difficult to measure it objectively, managers engage in subjective assessment of the synergy. So you know very well, when people go for making some subjective assessment, biases are invited by the people, and this overestimate the synergy. So when you overestimate the synergy, and actually that synergy are not going to be realized, and investors realize that on time, what will happen? They will penalize you. How they will penalize you? You will see that when a company announces their merger you are very likely to see that their acquiring firm's share price is going to depreciate. Acquiring firm's share price is going to fall. So investors realize that this firm is now overvalued. That's why they attempted for merger activity. So how managers exploit the investors' perception during the merger activity? Say, for example, in a market, for some reason, a firm is overvalued. So there are a number of reasons why a firm can become overvalued in the market. So you already have got several reasons from your earlier earlier classes that for what reasons a share might be traded at a high overprice. So when a firm is overvalued by the market, at the same time, some or investors are also perceiving that if there is a merger between, remember, as the firm is overvalued, it is not known by the investors. It is only known by the managers, because there is a information asymmetry between the managers and the investors, and there are constraints, more constraints in the hand of investors and less constraints in the hand of managers. So for example, a firm is overvalued, and the shares are overvalued, so it is very easy for the managers to know about this, that our firm is overvalued or our firm is undervalued. So sometimes you see that for unusual hike in the share price of particular company, the market regulators send notices to the company managers and ask for the explanation. Have you seen this kind of event? Regulator observed that unusual price hike is happening, and they send notice to the company managers, give explanation why. Do you have any undisclosed information?
Price sensitive information.
Right? You have seen it, right?
The company always informs that there are no undisclosed information.
Okay, that is very common in our country. We do not know why our price is going up. Okay, we also don't know why our price is going down. Okay, but that is happening, and investors, it is sometimes discovered that investors know more about the firm relative to the managers. Though managers are the internal party, investors are the external party. Okay, so what was our point, that why managers have less constraint, why investors have more constraint? Okay, so managers know it more precisely whether their firms are overvalued or their firms are undervalued. So when their firms are overvalued, what they do, I mean, what managers do, managers issue more shares to take more premium, and in case of underprice, they do just the opposite. Okay, so it is very possible for the, there is no restriction on this kind of activity. Okay, but you see, at the same time, if investors recognize that this firm is overvalued, so what is the investment strategy for this kind of investor when they recognize that this particular holding is overvalued, or this particular firm is traded at a higher price? What should be their strategy? Buying more share or selling short? What you will suggest? Have you got the question? If investors recognize that a firm is traded at a higher price, or not at a higher price, I mean the overpriced, it has become overpriced, what will be the investment strategy for that investor, for that particular firm?
Sell it.
Investor will sell.
Selling short, if they do not hold it right now. Okay, so do you know that short selling is permissible in our country? You are familiar with the concept short selling?
It is not permitted, sir.
Is it permitted?
No, sir. No, sir. No
It
short
is
selling,
not
sir.
permitted.
No, sir.
So what we are saying, there is a constraint in the hand of investor. They are restricted. They cannot do what they want to do. But at the same time, we are seeing that managers are doing what they want to do. So who is in more dominant position? Who is in more dominant position, managers and or the investors?
Managers.
Managers are in that dominant position. It has been found in many cases that managers are not restricted by so many constants like the investors. So so for that reasons, managers are very likely to exploit their the time, also exploit when it is the time to exploit the irrational move of the investors. Okay. So it has been found that though synergists are believed that it is possible to gain from the merger, but in reality, in many cases, it has been found that the share price of the acquiring companies go down, and also the synergies what were expected before the merger, they are not present in true sense. So there are, so one thing is that what managers of overvalued firms do, managers of overvalued firm engage in acquiring activities. So say for example, there is a firm A, there is a firm B. If for some reason firm A is overpriced, firm A is overpriced based on their share price, and firm B is here, and firm B has recognized that their shares are overpriced. So what can they do? They can buy the firm B at a higher priced security of firm A. You probably have heard about the stock payment or versus the cash payment during the acquisition. So I'm just mentioning the stock acquisition. So when the managers of company A are offering their stock, their overpriced stock to stockholders of B, what is happening? The shareholders of company A will gain in long run, but the shareholders of company B will lose in long run. So it actually happens during the when managers recognize that their firms are overvalued by the investors. So the question is why the managers of firm B are agreed to get or to become the target firm, or to get acquired with the company A, or to get merged with the company A. What might be the reasons why managers of company B engage in this kind of acquisition? You already have recognized that why managers A have decided to acquire the company B, because they have discovered that their company is right now overvalued, and now if they buy company B at this overvalued price of their share, it will be cheap to buy. So the question is why managers of acquired firms go and agree with the managers of the acquiring firms. So one particular explanation is that the managers of the target firms may be considering the short-term perspective. So they are not thinking the long-run outcome very seriously. So they believe that if they can gain from short run, it will be better for them. So there are reasons why they are preferring the short run horizon. Maybe they have been offered some payment, which I will mention in the second point, which are attracting them, or managers in the target firm are in the short-term perspective because they are very close to their retirement age. So when you are very close to your retirement age, you will not be very agree to think from the long-run perspective and to keep with the firm in which you are right now holding managerial position. And also at the same time, if you are given some stocks by the acquiring firm, and as the acquiring firm's shares are trading at a higher price, it might be possible for you as you might be given some stock options. You will be able to cash out your equity position at a higher price. So there is kind of cash gain. And target managers also expect that if they agree to be acquired by the acquiring firm, and though their consent is not very voluntary, their consent is a kind of acquiescence. Acquiescence is a kind of consent that I have been forced to give consent, but I am not very happy to give the consent. So this kind of example, this kind of consent is known as acquiescence. So when managers express their acquiescence, they might be given some stock options, they might be given some severance pay. Severance pay is a kind of payment given to the employees of a firm for the termination of their employment contract before the stipulated time. So say, for example, employment contract will be valid for 2050, but they are giving offer that if please retire in 2021, early termination, I will give you this amount. So this kind of amount what will be given is known as severance pay. And or I will offer you the position in the operations. So this kind of rewards encourage managers to managers of target firm to give acquiescence. But these are the points what we just have made are more and more appropriate in case of stock acquisition when a stock is overvalued. These are not very appropriate in case of cash acquisition, because in case of cash acquisition, acquiring firm look for the undervalued asset, and it is more easier also for the target firms to know that how much of their asset value is and how much of cash they are getting. I mean, the valuation in case of cash acquisition is relatively easier and relatively more objective compared to in case of a stock acquisition. And the risk of getting acquired by the acquiring firm with the overvalued stock gets lower. I mean, the risk is lower if the acquisition is made through cash acquisition. So we just have seen one example that how managers exploit the overprice of their firm. I mean, overprice has been caused by the investors' irrational behavior. And one particular example of Catering is the changes of company name. We just have given the brief idea that what happened in the late 90s. And it has been found that when the company announced, I mean, okay. Say for example, July 1 is the announcement date. Announcement date for what? Announcement date can be compared with the declaration date you see in the company disclosure in our country. So let's say July 1 is the next announcement date. So something new announcement will be made in the July 1. So right now, today is June 17. Okay. So it has been, I mean, during this time, let's think of, we are in the time of, what should I say? We are in the time of 1987, say 1997, 1997. So say we are in this time period. Okay. So it has been found that say a particular company is going to announce something in the July 1, 1997, July 1, 1997. And for some reason, it has been leaked. The information has been leaked on this date in the chat group or in some messenger group that this company A, is going to announce that company A will become A.com. Company A will become company A.com. So during this time, when this was leaked, it has been found that their share price went up. The share price went up. And on an average, it has been found that cumulative excess return registered on an around 74% during a 10-day announcement window. So the companies which are going to announce that they are the .com companies, and for the investors' excessive optimism with regard to the .com, they raised the price of those companies' share to a level that 74% return happened in just 10-day announcement window. So what is the announcement window? Announcement window is a kind of this kind of time frame. Say this is the time point at which this announcement will be made, and a prior time period is considered that when this movement has started. So as there has been no new information during this point of time, and it can be recognized that the price started to increase on June 17, 1997 for belief among the investors that something new information is coming that is kind of positive. So that's why this time frame, during this time frame, 74% return happened. And also it continues several days after this. You probably can relate it with also the earnings announcement drift. Okay. Now the thing is that share price appreciated after an announcement. Announcement for what? Announcement that they will become .com companies. And it has been found among 147 firms who have changed their names in this fashion from the June 1998 period to July 1998 period. So that period is more popularly known as .com bubble, and that period also remarked as the period for internet craze. because internet started to become popular on in those years. So it is now internet is now that time is not comparable in any way with current time. Okay, so what happened actually, company managers recognize that if I can change my company name to .com, and as investors are preferring those companies which have the .com in their name, so it's better to change my company name to the .com. So I already have given example to you that sometimes some firms which do not have any reliable connection with the internet, I mean connection means here relation with the internet, they also engaged in this kind of activity, and they also generate a return for their shareholders. Okay, let me give you now, let me give you some reason explanation or some examples from our country. Have you recently heard about that GSK has changed, GSK Bangladesh has changed their name to Unilever Consumer Care? Have you heard about it?
Yes, sir.
Okay. So does this change in the name contain any new information? You see, before the announcement of the changes of this company name, the acquisition already happened.
Around 2000 to 2100.
Yeah. So Unilever, like other countries, Unilever in our country, Unilever Bangladesh already acquired the shares of GSK, GSK Bangladesh, and that transaction actually happened a couple of months ago. But you see, that information contained information. Which information? That Unilever or GSK Bangladesh is going to sell their stake to the Unilever. Okay, that disclosure contains some information. But when GSK Bangladesh has given information that we are going to change our company name to Unilever Consumer Care, does this transaction, does this disclosure contain any new information which will change the intrinsic value of this company?
No, sir.
Okay, any other opinion? Anyone like to have different opinion that this actually contains some information, because this is now, this will be now under the Unilever Bangladesh, will be in the better management.
It has been assumed that Unilever has a better supply chain management. So the Horlicks lineup or the GSK's product lineup might be benefited from the supply chain management of Unilever.
Okay, but remember when Unilever, when GSK Bangladesh announced that I'm going to sell my stake to the Unilever Bangladesh, that disclosure didn't contain this kind of belief. I mean, Unilever has a better supply chain to manage this product. But when Unilever decided to buy the GSK Bangladesh stake, and that disclosure was made on that time, so why investors didn't believe on that disclosure that something good is going to happen? So nothing new should add when only the name will be changed. I mean, when the acquisition transaction will would happen, that the positive thing already has been shared to the investors, that why we are going to sell our stake. Am I clear?
True, sir. True,
to
sir,
my
yeah.
point? So the point is that whatever or in which case of or in which course of finance you learn, make it very clear that whether new information has come or not. If you believe that a noise is an information, in that case you are going to make a wrong decision. So changing of the company name is a kind of noise. Information is something which will give you some value, which you didn't know earlier. Okay. So these two things should be more precise. So say, for example, my name is X. It is like this kind of case. My name is X. I have changed my name from X to Y. Does it contain any new information? Will it change my value?
No, sir. Changing the name doesn't get any more value.
But if the company, say for example, X company has decided that we are not doing well, so let we sell our company to Y company. In that case, this information, this is invalid information, right? And this information contains value, right? But when X company has decided that I will change my company name to Y, this should not have any impact, right? Exactly the point what we are trying to argue for last half an hour regarding the .com name. Am I clear? So you need to be very clear to separate this noise out from the information. In that case, you will be going for making a good decision. And why I am trying to stress this thing out, what you will be doing, you will look for the Unilever Consumer Care share price in the DSC website, and you will see on the date in which the GSK disclosed that we are going to change our company name from GSK Bangladesh to Unilever Consumer Care. What happened to their share price on that particular day? You will look at the history, and you will see what we are what we are discussing here.
Actually, sir, যেটা হয়েছিল যে টিকার চেঞ্জ হয়েছিল টানা স্যার এক সপ্তাহ হল্ট ছিল স্যার 2100 টাকা থেকে 3600 টাকা।
ওকে, সো হল্টের কারণে তো কিছু হওয়ার কথা না।
মানে এটা মানে টিকার চেঞ্জের কারণে, নামটা চেঞ্জের কারণে কিছু হওয়ার কথা না, বাট মানে অলমোস্ট কত প্রায় 70-80% প্রাইস ইনক্রিজ করেছিল স্যার।
ওকে, so that also happened in the same time in case of so far I can recall Munno Ceramic. Can you recall that the same
LHB এর মনে বেশি হয়েছিল স্যার, যে লাফার্জ হোলসিমের ক্ষেত্রে হয়েছে।
Yeah, okay. And also same thing happened for BSRM.
BSRM স্টিল মার্জার স্যার, মার্জার এন্ড তারপরে আবার ডিমার্জ করে যেটা করা হয়েছে।
Yeah, other than the merger case, probably there was an event that they changed their company name. It is BSRM or another company. Right now I can't recall, but several companies have changed their name in last year. Okay, and because I learned about this catering concept in previous year in my MS Finance course, I tried to look at what is going to happen to the stock price of this company when they have declared that they are going to change their company name. So surprisingly, I discovered that investors took it as a new information. So what we are trying to conclude here, that it is not a case in our country also, it actually happened in other parts of the world. So they also believe that when a company changes its name, they are they believe that it is a new information. So what you should believe from today, changing the company name is not a changing the company name is not a fill in the gap.
New information.
Changing the company name is not a new information. Very good. So if it is not a good, if it is not a new information, that should not have anything to do with the intrinsic value of the share, and that should not cause any changes in the share price of that company. If there has been any changes in the share price of the company, for this kind of disclosure, you have to believe that irrational investors are playing in the market, and you have to, as a rational person, you have to capitalize on that kind of market move. Okay. Okay. So let's concentrate our discussion to another catering example that will be that is related to the dividend policy. But before that, I'd like to take 10 minutes break, and I would also like to give you 10 minutes for refreshment, and we will resume at 8:40 p.m. Okay, let's resume our session. We like to discuss another example of catering used by the managers, which is related to the dividend policy. We mentioned the brief idea that how dividend policy is changed based on the investor's preference, regardless of the company characteristics, company growth rate, or having the profitable opportunities. So the background discussion is with respect to the finance policy in relation to the dividend. You probably have learned the popular model from the Modigliani Miller, that who believed or who argued that dividend policy does not have any matter, and dividend policy is a kind of irrelevant in perfect market when there is an absence of the market frictions, which are taxes, transaction cost, asymmetry of information, and there has been no significant changes in the firm's investment and financing policy. Why Modigliani Miller argued in that way? Because they showed that it is possible to replicate the cash flow what company will be giving to the investors by the investors themselves. So if company pays more dividend, but company pays more cash dividend, but investors do not like it, investors want to keep his or her money invested in the stock. What investors can do, investors can take out the cash dividend from the company and keep the cash amount what he or she is required, and reinvest the remaining cash amount in the company stock again. And in another case, when company gives cash dividend which is less than the amount expected by the investor, what investor can do, investor can sell off his or her portfolio for that firm to that extent, which will give him the cash balance required for him. So instead of relying on the company dividend policy, it is possible for the investors to have the required cash balance by the investors by selling of the stock or by reinvesting in the stock. So this concept, what we just have mentioned, is popularly known as homemade dividend. This concept is known as homemade dividend. So it is not always possible because it is not always possible to meet up the need of all investors by managers because diverse investors have diverse needs. So that's why it is really difficult to stick on to address all expectations of all investors. So in general, companies try to maintain a stable dividend policy, and because significant changes in the dividend policy hurts the investors, and company shares are penalized if the changes in the dividend policy is not in the line of expectation of the investors. So it is the case of neoclassical case what we just have made. So what investors can do, investors can set his or her own dividend yield instead of relying on the company dividend policy. But in reality, what we have seen that the way or the context in which Modigliani and Miller assume that dividend policy is not matter, and investors can replicate the dividend yield, or investors can fill his or her own expectation of dividend yield, it is not always possible because of the presence of information asymmetry, because of the presence of taxes and transaction cost, because of the divergence in the applicable tax rate for the dividend gain and the capital gain. Though there were much difference in the tax rate applicable for the dividend gain and the capital gain for last couple of decades, but nowadays, if you look at the applicable tax rate for dividend and applicable tax rate for, I mean, the marginal tax rate for dividend more precisely, and the marginal tax rate for the capital gain, in most of the country case, you will see the difference is now very insignificant. So there will be no advantage if anyone prefers the capital gain or if anyone prefers the dividend gain. So because these things have been, these issues have been addressed by the government to mobilize enough tax revenue. So what thing we like to address here is that what Modigliani and Miller assumed regarding the dividend policy is not altogether prevalent, and the context is not always prevalent, and the dividend policy does matter. So let me give you some example from your personal life. Say, for example, a company has, in addition to your salary, you are also dependent on the dividend paid by a company in which you have made investment. So say, for example, that company has reduced their payout by 30%. So let's assume that for the amount, X amount of investment to that company, your cash flow from the dividend amount will go down by 30,000. Will go down by 30,000. So earlier, when the dividend policy has not been, I mean, the payout has not been declined by 30%, you used to get 30,000 more. So from this year, let's assume that you are getting 30,000 less. So I'm giving you two options. So one option is selling some of the stocks from your portfolio and get 30,000 cash. This is one way, because your consumption has not changed, but your cash inflow has changed, reduced by 30,000. So you have to look for the alternative ways to meet up your consumption. So one way is to sell off some stocks from your portfolio by 30, which will be giving you 30,000 cash flow. This is one way. And another way is to reduce your consumption by 30,000, so that you will not require the 30,000. Which one you will prefer? There is a third option, that is cursing the company. That why you have changed the dividend policy, I will not hold your stock any longer. I will not hold your stock anymore. That is out of our option. But out of the two options I just have mentioned, which one you will prefer? I believe that you have got my question. Have you got my question? I'm waiting for your response.
Sir, better to choose option A, to sell off and get the 30,000, because reducing my expense is unlikely.
Okay. Let's assume that you are exactly the same person of whom we are talking about. Will you do it really if you are, will you follow your own advice? If you are right now in the shoe of the same person? Obviously, we are understanding that by selling 30,000 worth of stock is better option without reducing or without hurting our consumption by 30,000. And if we follow this, we are religiously adhering to the homemade dividend concept of Modigliani and Miller. And just asking the follow-up question: if you are a person, the same person of whom we are right now talking about, will you exactly do the same thing which you have taken as a preferred option? Will it be very easier or will it be a very difficult decision for you? Have I put you in a challenging position?
I'm not sure, sir. I'm not sure.
Okay. Just share the issue that will it be very difficult to think in this way, or it would be very easier to think in the way, I mean the Modigliani and Miller way. I remember you are in the behavioral finance course, and you know that what kind of biases induce investors or induce people not to act rationally. Remember, Modigliani and Miller represent the rational people and how rational people think. Modigliani and Miller represents their thoughts, not the thoughts of irrational people. Will it be difficult issue or it will be easier issue? Just end up here and we'll continue. I mean, selling portfolio of 30,000 will it be a easier option to switch from or to balance the 30,000 decline in the cash flow, or it will
Well,
be
selling is easier, sir. I think selling is easier.
selling is easier. Okay, remember you already have picked it. When you have picked it, there is no presence of this. Okay, now I'm just asking that this decision is very easy. It is very easy, or it will be a difficult task for you.
Easy, sir.
It will be very easy. Okay, so you are very close to the rational person. I mean, your thoughts are aligned to the thoughts of rational person. Okay, that's good. But can you recall that the framing effect? You probably can recall the framing effect. So it has been found that, okay, if there is no framing effect, there is no biases invited for the framing effect to the people, the decline in the payout of 30,000 and increase in the cash flow by same 30,000 by selling stock and without hurting my consumption is the total story. But if the framing effect influences us, we would assume that this 30,000 is different from the 30,000 which would be given by the company in the form of dividend. For the framing effect, we would think that the 30,000 given by the company in the name of dividend and the 30,000 I am getting by selling of a portion of my portfolio are different thing. But if you take it in aggregate form, there should not be no difference. There should not be any difference. There should not be any difference. These are the same. This 30,000 should be same as this 30,000. Whatever the way you are choosing to take it. Okay. So what we are learning, or what has been observed, that investors do not take this decision in a very easy way. But when they when they see that company has reduced the dividend, they do not go for selling their stock, and they feel that it will hurt their wealth, and they adjust in other ways. They adjust their consumption in other ways. Either they go for reducing some portion of their consumption, or they go for increasing their alternative income, or they go for making some portion of borrowing. They go for in this way. So why they go for alternative ways instead of selling 30,000 worth of stock? Because they do not find it very easy. So it is the findings of some studies you would get in the web resources. Okay, so what is the conclusion here? That the argument that dividend policy does not matter is not a very straightforward argument. It has counter argument, okay, because of the presence of frictions in the market. Okay, now can you recall the pharma friends? Can you recall the full name of pharma friends? Eugene Pharma and Kenneth Friends, who are the Eugene Pharma is known as the father of modern finance. Are we aware of this information? He's a kind of living legend. Okay. So their main, they have several contribution, and each of their contribution is very remarkable. And in addition to their contribution regarding the cross section of stock and bond return, where they have made the conclusion that market beta is not the only factor which explain the cross section or differences among the stock return. In addition to the market beta, we should take other two betas. One is the size beta, another one is the value beta, and we need to look at those. Okay. So after ending of today's class, I will try to show you how size beta is measured by pharma. Okay. So before that, we like to why we have invited their name. The reason is that the study of which findings you are right now seeing on the screen. This study was made by the pharma friends by taking the firms from 1972 to 1999, which are listed in the New York Stock Exchange, American Stock Exchange, American Exchange, and the NASDAQ, which is the dealers market, NASDAQ. And they found that, or they concluded that the payout ratio of the dividend, they pay out, the companies who pays dividend out of the total companies are on decline. So in 73, they mentioned that 52% of the publicly traded non-financial, non-utility firms paid dividend. But in 1999, it dropped to 20.8%, and it was 66.5% in 1978. You see, if we try to graph it, 52.8% from here, it increased to 66.5%, and then it dropped to straight 20.8%. And when it happened, this happened in 1973, and this happened in 1978, and this happened in 1999. So in general trend, it has been found that the percentage of the companies who pay dividend or who have payout ratio, their percentages are declining, in the declining trend. So in general, what we mentioned in the beginning of the class, that the mature growth firm, some mature large firms who do not have much profitable opportunities right now, these are the characteristics of the dividend paying company. And the opposite things, small firms who have more growth opportunities, who are not much profitable right now, but expecting to be profitable in coming days, there will be the companies who will be the non-dividend paying company. So these are the some characteristics of the dividend paying company and the non-dividend paying company. So pharma friends asked, what are the reasons, what are the potential reasons why the number of companies paying dividend are coming down? Are this reason for that their characteristics have been changed? They have become less profitable, they have become smaller, they are now have less cash balances. Are their characteristics have changed over time because of paying less dividend? For these changes in their characteristics, are they pay less dividend nowadays? That is the question asked by the pharma and friends in their paper. So, but they concluded that the changes observed in the characteristics of the company, but we believe that half of the explanation for change for reduction in the payout by the companies, or the percentage of the companies, half of the explanation can be made for this reason, that their characteristics have changed. But what is about the another half of the explanation? So out of the 100% reason, 50% reason can be explained by what? Can be explained by changes in the characteristics of the company. Say that those companies have become now less profitable, those companies do not have now much cash balances, or those companies, half of the explanation can be made. But what about another 50% explanation? And it has been found that new listers in the 70s tended to be quite profitable. Earnings of the newly listed company on an average was 17.88% of the book value, relative to the market average of the all companies, where 13.70%, I mean their earnings are 13.77% of the book value. And in this period, I mean from 1993 to 98 period, I mean during this period when it dropped to 20.8%, I mean closer to this period, what happened? Newly listed companies' earnings to the book value ratio was 2.1%, which was 11.3% for all firms. So note that the profitability dropped from earlier period from 17.8% to 2.1% on an average during this period. So one particular explanation can be made, but that particular explanation will be responsible for 50% explanation. But what about the other 50% explanation? So other 50% explanation, the answer to the other 50% explanation was explored by the behavioral finance theorist. So they wanted to ask some questions, say that whether there has been any linkage in the fall of the dividend with the changes in the time, or the variation in the time is responsible. So one thing they attempted to relate, or they attempted to explore in this way, say right now, say economy is not going well. Economy is not going well. So if the economy is not going well, as an investor, what will prefer? Dividend paying companies or non-dividend paying companies? If the economy is not doing well,
Dividend paying companies.
you will be preferring dividend paying companies. And if the opposite thing happens, say for example, economy is recovering, economy is overheated, employment is very good,
Non-dividend paying company.
right, you will be more confident to hold the non-dividend paying companies. Exactly. Okay, this is a kind of common trend. You might argue that I would do different. Okay, but this is a kind of general perception that happened. Okay, now if you prefer, or if all investors prefer, this is just example that in which time, I mean because of the variation in the time, the preference for the dividend paying companies and the non-dividend paying companies vary. So which I like to ask you that if you prefer dividend paying companies, or if investors prefer dividend paying companies on a certain point of time, will the dividend paying companies be traded at a higher price relative to the companies which are non-dividend paying, when investors are preferring the dividend paying companies?
Dividend paying company should be trading at a higher price.
Okay, because investors are nowadays preferring the dividend paying companies. And opposite thing might happen when investors are not preferring the non-dividend paying companies. Okay. So there is a ratio which can be measured, that is if you look at the average market to book value, average market to book value of the dividend payer, and subtract the average market to book ratio of the dividend non-payer. Say for example, let me take it very simple case. Okay. Say for example, today average market to book ratio of the dividend paying companies are 20, and average market to book ratio of non-dividend paying companies are 10. In that case, this ratio is known as dividend premium. This gap is known as dividend premium. This gap is known as dividend premium. Now tell me in which case dividend premium will be positive and in which time dividend premium will be negative.
Dividend premium should be positive while economy is doing bad, and vice versa.
Economy is doing
Bad.
bad,
Premium
right?
will be higher.
Yeah. Okay. Now, so if you calculate it for each day, or if you calculate it for each month, you will get it. Okay. So what behavioral finance theorist Baker and Ugler, you probably have heard about these two people name, right? Can you recall from when you have heard about this two people name? I mean, two authors name. Can you recall in which lecture you heard about this people name? In which lecture?
Sir, maybe from 9th.
Maybe from
স্যার বেটা যে ক্লাসে বুঝিয়েছিলেন
beta.
সেন্টিমেন্ট বেটা
Okay, I have mentioned beta in several classes. That is a kind of open answer. Okay. Can you recall that in one class we discussed about the sentiment indicators? We mentioned
Yes,
about
sir.
the sentiment index.
ইনডাইরেক্ট
We-
ইন্ডিকেটর এন্ড সেন্টিমেন্ট
Indirect indicators, we mentioned about the BW sentiment index. Can you recall? We showed
Yes.
one graph. So Becker and Ugler are those people. Okay. So though they have a good number of publications, I mean very dominating papers in the behavioral finance, both people. Becker is from Harvard University and Ugler is from New York University. Okay, so what I'm trying to share here, that Becker and Ugler look for the relation that whether dividend premium, remember what we just have made the definition of dividend premium clear. They look for that whether dividend premium has any influence on the company's dividend policy for dividend initiation or omission. So what is initiation and what is omission? Initiation means giving more dividend or starting to pay dividend, and omission means cutting dividend and reducing the payout. Okay, so they try to look for the relationship between these two variables. This one is the dependent variable, this one is the independent variable. Have we got the context? What we are trying to see in the coming discussion? Okay. So they have found that this kind of pattern. You see the blue dashed line, okay. So blue dashed line indicates the dividend premium, and the black solid line indicates the dividend initiation. And if you see the initiation is getting in a negative direction, you have to connect it with the dividend omission. Okay, you see the source of the paper on the bottom of the screen, Baker and Ugler 2004, appearing and disappearing dividend. So on the vertical axis, we are representing dividend premium percentage and the initiation percentage. So dividend premium percentage is the ratio coming from the difference of the market to book ratio of dividend paying companies and the non-dividend paying companies. So first of all, we would like to see the blue dashed line. You see the blue dashed line, I mean, which indicates the premium paid by the investors to the dividend paying company. So you see it, it is in this level during the before 1954. Okay, but after 1954, what happened? It dropped until 1968, 69 or 69 or 68. It dropped. Okay, again it went up till 1973 or 1972. Then again this dividend premium dropped during this period from 1981 to 1984. Then again it goes to a level close to zero during this period, which is 1991. Then again, after some fluctuation, it dropped very sharply, a straight drop during this period in 2000. Okay. Then again, it went up after 2000. Okay. At the same time, I mean, you can look at some relation, lag relation. So you see, when this is going down, I mean, okay, let me take a long period. Okay, this one. Okay, what happened here? Who have been given more price, the dividend paying company or the non-dividend paying company? If the dividend premium fell in this in this time, who are rewarded, dividend paying or non-dividend paying? Remember what we have learned in the premium definition. If the premium dropped, what happened? Dividend paying company got more market to book value, or dividend non-paying companies got more market to book value? You see, it went to a negative region also. What happened? Try to say something so that I can understand where are you and how much I have to tell you. Try to tell what you are looking at or what you are understanding based on our discussion. Who are preferred by the investors? Dividend paying or non-dividend paying?
Dividend paying.
Dividend paying. Premium was falling.
প্রিমিয়াম কমে গেছে, তো নন ডিভিডেন্ড পেইং কোম্পানি তার মানে প্রিফার্ড।
Non-dividend paying companies are given preference by the investors and they are getting more market to book value relative to the companies who are dividend paying. Okay. So if it is true, if it actually happened, managers will be deciding to pay dividend, or manager will try to initiate dividend or will try to omit the dividend.
They will try to omit the dividend.
They will try to omit the dividend. And you relate the blue line. Blue line is in the, you see there is they are going in the same direction, and they are going to the same point, but both are represented in secondary vertical axis. This is the secondary vertical axis, and this is the percentage of the dividend initiation and dividend omission. Okay, you see the black solid line is falling. Okay, at the same time when blue line is going up, what happened during this time? Who are rewarded by the investors? Dividend paying companies or non-dividend paying companies? When this premium is going up, premium was going up.
If premium is going up, dividend paying companies share prices would be better.
Okay, so what would manager do in that case, in this period?
Their payout becomes higher.
And you see that after looking at this in the later period, okay, not immediately, in the later period, what manager would try to do? Manager would try to initiate more dividend, because they have observed that investors pay more to those companies share which are paying more dividend. That's why they initiated more dividend, and this line sloped positively. Okay, and during this time, you see, during this time, dividend actually disappeared. Dividend actually disappeared in the later period of time. And based on this observation, Baker and Ugler classified the periods into 4 periods. We'll look at those, but before that, we like to see what we have learned. When dividend premium rises, it reflects the increased investors' preference for dividends, so that initiation for what? Initiation of dividend tend to subsequently, remember, subsequently, not concurrently. Subsequent means, say for example, dividend premium is positive in T period, and you are expecting to see that more dividend will be initiated by the companies in the T+1 period. I mean, dividend premium is followed by, positive dividend premium is followed by dividend initiation, and negative dividend premium is followed by dividend omission. So subsequently means it dividend premium is followed by dividend initiation. This do not happen concurrently. Okay, there is a lag relationship. So what is lag relationship? You probably have heard about the leading indicator, lagging indicator from the macroeconomics. Okay, so for example, an economy is going to rebound. What is the leading indicator? One leading indicator is the stock market index. Say for example, if a stock market index of a country is reaching at a very high level, you should expect that the booming of the economy is coming in within several months. Okay, so in this way, it is a leading indicator. And what is the lagging indicator of the economy? So one thing is that, for example, unemployment is a kind of lagging indicator. So for example, economy is in a recession. So you will see that unemployment, that hunger, then suicide, this socioeconomic changes would be observed after this recession happens. Okay, this do not happen all on a sudden. There is some leading indicator, there are some lagging indicator. So why I am trying to make it clear? Because the dividend initiation and dividend premium, dividend initiation or dividend omission happens in a lagged fashion with the dividend premium. So if in this year you managers see that dividend premium is positive, they will be deciding to initiate more dividend in the next year. Okay. Okay. On the opposite direction, on the other hand, when dividend premium falls, it reflects that investors are preferring those companies which are paying less dividend or not paying dividend. In that case, initiation tend to subsequently fall. Okay, these are the interpretation from this paper. So in this way, how managers exploit the investors' behavior and make changes in their dividend policy. So this kind of explanation, what we are just making, cannot be explained by the neoclassical finance. Okay, so let's try to classify that how Becker and Ugler classified this period of dividend initiation and dividend increase in dividend initiation and decrease in dividend initiation. So first period is the increasing trend in the mid 1960s. So mid 1960s is this one, increasing trends in the mid 1960s. So this is this period, increasing trend in the mid 1960s, and then a decline falling into negative territory through 1969. Up to 1969, what happened? This is a decreasing trend. This is the second period. Okay. Remember, we are looking at the solid black line. I mean, we are focusing on the initiation. So this is the number 1. This is the number 2. Okay. Then the number 3 is the positive trend in the 1970s, which stayed up to 1977. Okay. So from the 1970, I mean, from here to here. So this is the third period, which have been observed as a positively sloped or positive trend of the dividend initiation. Okay. After that, this period, I mean, this period has been classified as a disappearing dividend, dividend disappeared. Okay. Well-known disappearing dividend period after that. So each of this trend, what can you do? You can relate each of this trend with the subsequent, I mean the, not subsequent, I mean the dividend premium in the earlier period. Okay. Corresponding fluctuation in the dividend premium. So this is all about what we have tried to see regarding how managers exploit the irrational behavior of the investors. And in the next session, we will try to see that how rational managers are also get affected by the behavioral biases. And that is all about for our today's session.